Hi, I'm John McElroy. Welcome to our presentation today on taxing your principal residence in Canada. There were significant changes that happened in this area in the 2016 taxation year. I wanted to walk you through them. What was the significant change? Well, in prior years, you were under no obligation to report the sale of your principal residence if no taxes were owing. If your exemption equaled your gain, fine, sell the house, no need to report it on your tax return. CRA was none the wiser. Life was a beautiful thing. I mean, you were obligated to report if there was taxes owing and your exemption was less than your gain, but otherwise, no. Starting in 2016, total change. Now, selling a principal residence must be reported regardless of whether a taxable gain occurred or not. Yeah, there's penalties involved, $100 a month up to a max of 8,000. Although CRA said they're not going to be aggressive in applying that, but it is something that is available to them. But I think the bigger issue, it's now going to be much easier for CRA to question the transactions in the first place. They know what happened, so now they're going to be able to question or audit, get more information, to make sure that the exemption rules were followed and you didn't contravene them some way, knowingly or unknowingly. I'm not accusing Canadians of being tax evaders, but my feeling is this. A lot of times Canadians weren't really familiar with all the rules that pertain to the exemption. They might have inadvertently contravened some of them, weren't aware of it, so they reported that the exemption was equal to the gain and didn't bother filing any taxes. Well, that's off the table. Now you are going to have to follow those rules because that transaction is going to be subject to more scrutiny because CRA is going to know about it. So I think this is huge. We need to know what those rules are. Let's start at the beginning. When you sell a capital property, the gain is normally taxable. We know that. And the same thing applies to any house you own. Principal residence or not, tax is going to be owing unless you qualify for the principal residence exemption, the pre, but the onus is going to be on you to prove that you qualify for the exemption. Here's a base case. Let's say you bought a house in '95 for $300,000, you turned around and sold it in 2013 for $340,000. You got a gain of $40,000. Is that gain taxable? Does the exemption apply? Well, let's get a little bit more information before we answer that question. What is a principal residence? How does a property qualify for an exemption? And what does ordinarily inhabit mean? Well, a principal residence is a housing unit, wide latitude really. It could be anything, a house, a cottage, condominium. It could be an apartment as part of a duplex that you jointly own with somebody else. Heck, it could be a trailer, an RV, or a houseboat. So wide latitude on that front. By the way, does the housing unit have to be located in Canada to qualify? The answer is no, it doesn't. That surprises people. Your principal resident doesn't have to actually be in Canada. So how do we qualify as a principal residence? Well, it's got to be a housing unit. You have to own the property alone or jointly with someone else. It's got to be ordinarily inhabited. There's that phrase again, by either you, your spouse, or your child sometime during that year. And of course, you have to designate that property as principal residence. That's an important issue when you own multiple properties, all of which you ordinarily inhabit in a year. Only one of them can be designated as principal residence. So what does ordinarily inhabit mean? It just means you live there for all or part of the year. Yes, vacation properties qualify. Even if you're there a week or two, that's sufficient for you to have ordinarily inhabited that particular property. So that's good news. And it's got to be inhabited by you, spouse, or child. We covered that. The last one's important too. You only ordinarily inhabit a housing unit if it's primarily used for living purposes and not for producing business income. So if 80% of it is a business and 20% of it is something that you use for living, no. Under the rules, you're not going to ordinarily inhabit that particular property. Let's take a look at the exemption and see how the calculations go. The exemption formula looks like this. 1 plus the number of years that a property is designated your principal residence gets divided by the number of years the property is owned by you. We multiply it all by the capital gain. That will tell us what the exemption amount is. Clearly, we can see that if the fraction is 1, then the exemption is going to equal the capital gain. We're not going to pay any taxes. Yippee. When I'm teaching this to students, sometimes I'll get questions about this 1 plus. It can be confusing because sometimes it seems like it needs to apply and sometimes there's no benefit to it. And then so therefore that will confuse students. So I thought I would just quickly walk you through a numerical example. There's the formula in a slightly shortened form. Years designated divided by years owned. 1 plus in the numerator by the capital gain. House A was bought in 88 for 200K, sold in 95 for 300K. Proceeds are 300, ACB 200. We've got a gain of 100K. Now, let's calculate the exemption. But you know what? Just for illustration purposes, for teaching purposes, let's drop the 1 plus from the formula. Let's pretend it's not there. Just the years designated pre over the years owned. In this case, it's going to be 7 over 7 because we bought it in 88, lived in it the whole time, was our principal residence, and sold it in 95. So the years designated, same number as the years owned. We get a 1. Our exemption's 100K. That's exactly what our capital gain was. Hey, good news, no tax owed. So this confuses students. They say, well, hang on a second. What do we need the 1 plus for? When we dropped it out, we got a satisfactory result, so why does it have to be in there? That's why I said it seems to convey some benefits in certain transactions, but no benefit in other transactions, and that can be confusing. Let me clarify for you. In 1995, we took the $300,000 from House A and bought a second House B. We held it till 2013 and sold it for $340,000. Let's calculate the exemption for House B, but once again, let's drop the 1 plus and see what happens. Well, our exemption is going to be equal to 17 over 18 times 40K. That gives us an exemption of 37.8K and a capital gain of 40, so therefore a taxable gain of 2.2K. Well, hang on a second. Why is there a 17 in the numerator of the exemption formula? We bought it in 95, lived in it till 2013. Why don't we get the full 18 years of the property being designated as our principal residence? Well, let's summarize or look at the rule to understand the answer to that question. And the rule says that a family unit can only designate one property per year as their principal residence. That's why we need 1 plus. It becomes important when an existing home is sold and a new one is purchased in the very same year. The +1 allows both to be treated as a principal residence. All right, so the effect of the 1 plus is that both A and B can be designated a principal residence in 1995. All right, and that's a good thing for us because when we put it into our formula, 1 plus 17 divided by 18 gives us an exemption of 40K, a capital gain of 40K, which means our taxable gain is 0, which means no taxes are owed. So we did need the 1 plus for House B. We didn't need it to have a taxable gain of 0 for House A. And the difference, of course, is in House B, we sold one House A and bought a second House B in the very same year. Hopefully that wasn't too confusing. Let's change gears. Different question. Still get this question asked, believe it or not. Can you split the ownership? This seems like a fantastic idea to people. Let's have mom own the house as a principal residence. Let's have dad own that cottage as a principal residence. And then when both get sold, they each qualify for the exemption. Both of them will be tax-free. Is that going to work? No. It hasn't worked since 1982. This rule was changed decades ago, but I still have people occasionally ask me about it. The rule now says the family unit has to designate one property as principal residence in any taxation year. It's not an individual thing now, it's a family unit thing. And so splitting it up, house and cottage, just does not work anymore. Those are the basic rules. And so now my premise in this video is we got to make sure we don't mess up and contravene these rules and ruin our principal residence exemption, because CRA is going to be much more savvy to the fact that a transaction occurred and can review whether we have in fact complied with the rules. So how can we mess up our exemption? What can go wrong? Well, let's start with change in use. There's two kinds of change in use. Number one, A, you buy a house, you move in, you stay there for a while, you move out, you don't sell though, you turn it into a rental property, and you produce some income. That's a change in use. The second one is the opposite. You buy a house, you rent it out for a while and generate some rental income, and after a while you move in, it becomes your principal residence. In both cases, we have change of use. Let's start with the first one, where we move in first and then we produce income later. Let's say you purchase the house in 84. You live there and it's your principal residence till 2011. You move out, but you don't sell. No, you rent the house out. Well, that constitutes a change of use. And under tax rules, it triggers a deemed disposition of the property, land and building, for tax purposes. Yikes, that's not good. All right, let me emphasize this. A change in use results in a deemed disposition. A deemed disposition means that you are deemed to have sold the property at fair market value and reacquired it at its purchase price in the very same year. Now people say, well, it's not too bad in this case because the gain from 1984 to 2011 will be sheltered by our principal residence exemption because we started off this transaction by living in the property. And that's true, but what about the future appreciation of the property, right, when it's rental income prior to it being sold? We rent it out for a while, generate some rental income. 2015, we sell the house. What does the exemption look like? Well, we know the formula. So in the numerator, we put 1 plus 27. Why 27? 27 is the difference between 84 and 2011. Those were the years that this house was designated as our principal residence. 2011 to 2015, it wasn't. We divide that out, we get 0.9, which really says only 90% of our gain is going to be tax-free. The other 10% is going to be taxable. Not good. However, there are rules to sort of give us a break, so to speak, in this area. And the rule is that when there's a change in use in your principal residence, such as outlined in this example, you can file an election. And that election says you want to continue to treat the property as a principal residence for up to 4 more years after you've moved out. You're no longer ordinarily inhabiting it. So you get 4 more years kind of as a freebie. It can even be longer in some cases, but I don't want to go through the criteria for that to happen because it would just make this video too long. But you have to file the election. I think a lot of times people have a change in use, they don't file that election. Right now you sell the property 10 years later, you haven't filed the election. Now you're in a situation that you don't want to be in. Maybe you're going to try to go back and file it after the fact, and it becomes all messy. But you have to do it because this is a big transaction for you. Selling a principal residence is the biggest financial transaction in the lives of, by far the majority of Canadians. So very important to file these elections. You need to know they exist, though, before you can file them. By the way, the election is only possible, as I've described here, in situations where you haven't claimed any CCA or tax depreciation on the property. This is extremely important. No way do you catch a break if you're trying to deduct depreciation on your principal residence to lower, business income, etc. All right. What was the second change in use? Well, it was kind of the opposite. You bought it in 1984 again, but instead of moving in, you rented it out to generate some rental income. In 2001, you move in. Then it becomes your principal residence, and you sell the house in 2015. What happened in 2001 under tax rules? You had a change in use. That's a deemed disposition. The property is deemed to have been sold at fair market value and reacquired at the very same price. But do you know something different this time? In the first example, we still had our principal residence exemption to shelter the gain because we were living in the property. But when you rent it out before you move in, you don't have that same shelter. In other words, the deemed disposition in 2001, hey, there's nothing to shelter that gain. That gain is going to be taxable. However, we can file an election in this case too, to treat the property as a principal residence up to 4 years before you move in, or potentially longer in some cases. This is worth investigating. If you're going to buy a property and you're going to rent it out with the idea that you're going to eventually move in, and you want to try to expand the number of years that it can be considered a principal residence to shelter more of the gain when you sell it, talk to a tax advisor. Get some advice. This is important. CRA is now going to know when you sell this property, and they can be asking some questions. Once again, you can't file this election if you have claimed any tax depreciation. One other thing to note, during the election period, no other property that you own can be designated as your principal residence, so you are shut out of that. Both of these happen frequently enough, but C happens, I think, much more often, and that is change in use just is partial in nature, meaning part of your home is used to generate income. You might rent out a room, you set up a home office, you've got a hair salon in your basement. Well, by law, if you set up a hair salon in your basement, you have a partial deemed disposition of the property associated with that partial change in use, meaning a partial capital gain can be triggered. And to make it worse, there isn't any election available when we have a partial change in use. If it's a 100% change in use, we have an election in both cases, but not for partial. But there is good news. And the good news is CRA says, you know what? We're not going to apply this deemed disposition rule and deem you to have sold a part of your property unless all three conditions are met. All right, what are these three conditions? They said, you know what? If the business use is small compared to the principal residence use, we'll let it slide. If 95% of the property is used for living purposes, 5% is used for business purposes, we're not going to sweat it as long as no major structural changes were made to the property. You can't claim that only a small portion of the property is used for business when you have undertaken major structural changes to prepare it and make it suitable for business. So if it's a small amount of the overall use and there's no structural changes and you didn't claim any tax depreciation or CCA on the business income that was generated, CRA's position is, you know what, we'll let it ride. We'll still consider this whole house to be your principal residence. We're not going to sweat it. Okay? So if you've got a desk set up in your basement and you're running a little business out of there, not to worry. You didn't make any structural changes. You put up a desk. It's a small part of your overall home. Don't, whatever you do, claim any tax depreciation or CCA. You'll be thankful in the end because when you sell it, you're going to get the full exemption on the gain. Okay, what are some other issues that can mess us up here? Well, land is one. One thing people don't realize is that you only have a restricted amount of land that you can include as part of a principal residence. The general rule of thumb is about a half hectare or maybe 1.25 acres. In other words, if you sell a home and 10 acres of land, not all that land is going to automatically be exempt under the principal residence designation. You might have to pay tax on some of your transaction. Now, luckily, there are some exceptions. In other words, the exceptions mean CRA will allow more than 1/2 hectare of land to be part of the package that's exempt from tax if certain conditions apply. I guess the one that comes up the most often is maybe it's just not possible to sever the lot. It's impossible. You have a 10-acre property and you have a housing unit on it. There's no way for you to sever that lot up and dispose of those properties in a transaction that would be taxable because zoning laws prohibit it. So if you can't sever it, you have no choice. And so therefore, in that case, you might get an exception. If additional land is just absolutely essential to use and enjoy your property, you can get an exception. Doesn't mean you want more land or you can enjoy more land. It means essential to use. Or if land is needed for access to public roads or things like that, you could get maybe an exception to include more land in your package that qualifies for the exemption. But don't just ignore the land. If you have a country property and you're sitting on your house is sitting on a lot of property, you got to think about that if you want to claim it as your principal residence exemption and shelter all of your gain. Other issues that can mess us up. Now, what about this one? Principal resident designation is only available on capital transactions. What the heck does that mean? It means if you're flipping houses frequently, you buy a beat up house in March, you fix it up over the summer, you live in it for a month in September, and you sell it in October, and you claim it as your principal residence, and you want to, of course, get the entire thing tax-free. CRA might object and say, you know what? That sale is not a capital transaction. It was an income transaction. You are in the business, my friend, of flipping houses. So these houses we're going to consider to be inventory in your business. It's not going to be a capital property. And to make the point salient, no principal residence exemption is available on transactions that are not capital in nature. So if you're doing this as a business and those houses are inventory, it's business income, forget about getting the principal residence exemption. Hey, you want to avoid double jeopardy because it's even worse. If you flip houses frequently, you're not going to get the PRE, the principal residence exemption, but if you sell it at a loss, you're not going to be able to deduct that loss because the house is going to be considered a disposal of personal property if you've lived in it. Yikes, mamma mia. So the house you live in is considered personal property even if it's not a principal residence that qualifies for an exemption. We call it double jeopardy. Let's avoid that if we can. Let's just go over a couple of other small issues quickly. How about joint ownership with an elderly parent to avoid probate fees? Came across this one this year. A portion of property was transferred in later years from an elderly parent to an adult child. Why? To avoid probate fees. When the elderly parent dies, it's already in the hands of the child, doesn't have to go through probate. We avoid those fees. But it's a risky transaction. Probably something we should better avoid. Parent purchased a house in 78, child is put on title in 2010, and the parent dies in 2016. Two bad results are possible. If the adult child does not ordinarily inhabit that property, then 50% of the 2010 to 2016 gain is going to be taxable on the death of the parent. If the adult child does not ordinarily inhabit the property, the entire gain at death could be tax exempt under the exemption, but the adult child loses the ability to designate their own home as a principal residence during that 2010 to 2016 period. And there's land transfer taxes that can also be a potential issue. So be careful that you don't just jump on a situation where you're put on title with an elderly parent to avoid probate fees. You could be on the hook for a much bigger tax bill because of an ability to mess up the personal residence exemption. Let's do one last one. It doesn't come up that often, so I'll go through it really quickly. It's kind of similar to the previous one, and that is sometimes people hold family vacation properties in a trust with multiple adult children as beneficiaries. You know, that's a way sometimes estate planning things work. If all adult children who are beneficiaries ordinarily inhabit the vacation property, they all visit it every year, well, you know what? The principal residence exemption could be claimed when the vacation is sold. I mean, the beneficiaries could realize a tax-free capital gain on the sale of that vacation property. But there's a huge but here, because they're going to be unable to claim the exemption on their own home for the years that the trust claims the exemption on the vacation property. You only get one property per year. So if 5 adult children are using up their exemption to get a cottage sold and avoid the capital gains, that's counterproductive if all 5 of them own their own home and they're precluded from using those years as part of their exemption when they sell their own home. So it can be a really sort of bad trade-off and potential messy, especially if some adult children own their own home and others don't. You know what? I think we've gone long enough. I think I've got the points across that I want to get across. So I'm going to end it there. This was Taxing Your Principal Residence in Canada. My name is John McIlroy. If you enjoyed this video, please press the like button. Also, please subscribe to this channel. I get some nice emails from people who enjoy these videos, which encourages me to make more videos. The more subscribers I have, the more feedback I get, the more likely I am to be motivated to put a few more of these out if they are in fact helping people. So do like and subscribe if you got anything out of this video. Meanwhile, I'll see you in the next video.